the Bank of Canada's Senior Deputy Governor in 2014 for a 7-year term. And as Senior Deputy Governor, she oversees strategic planning and the economic and financial research of the bank. She shares responsibility for the monetary policy decisions with the bank's governing council. She oversees the bank's analysis of international economic developments and serves as the bank's G7 and G20 deputy. She represents the bank on the Financial Stability Board and is a member of the SFB's Standing Committee on Assessment of Vulnerabilities. She's a member of the IMF's High-Level Advisory Group on FinTech, and she chaired the FSB's FinTech Issues Group. She's twice been the recipient, as you could probably imagine, of Canada's Most Powerful Women Award, Top 100 Award, by the Women's Executive Network. Like me, actually, she holds a BA, an honors BA from Wilfrid Laurier University, and a master's degree in economics from Western Ontario. When I was there, it was the University of Western Ontario. You know, Carolyn, if you were Western or, yeah, now Western University. Following Ms. Wilkins' speech, I'll sit down, we'll have a little conversation. I'm hoping that the questions will come from the audience, and so as you're listening, as things pop into your mind, save your questions, and she'll be happy to take questions at the end. So without anything further, thank you so much for being here, Carolyn.
Well, hello, good afternoon. Thank you so much for that very warm introduction. And I'd also like to thank the UBC Vancouver School of Economics and the Vancouver CFA Society for the invitation. I've been in Vancouver for the past couple of days, and I've been meeting with businesses, some students, as was already said, and even been for a run. And you just can't help but notice how Vancouver is truly a global city. There are over 80 consular services here that are servicing foreign-based firms who are doing business in the region. There are students from around the world that flock to the universities here, and people from around the world have decided to invest in housing here in the region. So I got to imagine that what's happening in the global arena has got to be top of mind for people in the room here. Whether it's the trade conflict between the United States and China, whether it's the myriad of geopolitical risks, the one we're reading about this week the most is Brexit. Those have to be top of mind, and of course they're top of mind for the Bank of Canada too. Now what worries me the most when it comes to the global developments is rising debt. Global debt now totals about $240 trillion US, and that's $100 trillion more than just before the financial crisis. And now it amounts to more than 3 times global GDP. And here I'm referring to total borrowing. So that's governments, it's businesses, it's households. And whether you're a homeowner or you're a business person, you know firsthand that high leverage can leave you in a vulnerable financial position. It's not much different with economies. And the world has learned this lesson the hard way on many occasions in my lifetime alone. And yes, I went to university at the University of Western Ontario when it was still called that, so that gives you a clue. So in the 60s, the budget deficits that the United States incurred and the loose monetary policy that went along with it laid the foundation for the great inflation of the 70s. And then, of course, the breakdown of the Bretton Woods system of pegged exchange rates. And the recession that followed then destroyed many businesses and left many people out of work. By the 1990s, we appeared to have learned our lesson. There were many central banks around the world that were adopting some form of inflation control regime. And this not only helped restrain the temptation to inflate away debts, but it also contributed to a decade and a half of economic stability. So we kind of roll forward to 2007, and we saw the beginnings of what would become a global financial crisis. Now, excess leverage was once again at the root of the problem, although this time it was in financial institutions and households. And the Great Recession that began that year lasted into 2009, saw governments and companies and people from all walks of life suffer the consequences. And even though Canada was really spared the worst of it, we were reminded kind of brutally how quickly the fallout can spread across economic borders. Now we're almost 10 years into the global expansion. Many of those that have lost their jobs have now found work again. Asset values have risen, and monetary policy in some countries is no longer at emergency settings. Still, the road that we took to get here, to recovery, has led us into an era of even higher leverage across many economies. Now, does that mean that the global economy is headed for another period of financial instability? Well, the global financial system is in a better place than it was in 2007 in many ways that reduces risk. There are nonetheless uncertainties that could throw us off track, such as how trade tensions might evolve. And in any case, when downturns do occur, high leverage is usually an amplifying factor. So what I'd like to do today is tell you where I see the trouble spots and what is required to manage them. But first, let's ask the question, how did we end up here again? Now, an important piece of the story is highly accommodative monetary policies that were needed to clean up the mess and get global growth back on track after the crisis. This, combined with an abundance of global savings, has kept interest rates low. Well, on top of that, many governments implemented large fiscal stimulus plans. Now, the downturn would have been even deeper and more painful without these very decisive policy responses. What strikes me, though, is how much overall leverage has grown globally, even as the financial sector has repaired its books. Now, government debt has skyrocketed over the past 10 years to close to 90% of global GDP. The debt of non-financial corporations has doubled over the same period, doubled. And of course, we all know that not all borrowing is bad. I mean, borrowing makes sound business sense if these funds are spent on productive pursuits. But that said, not all leverage is created equal in terms of risks that it poses to the system and to the individuals that have taken on the debt. The creditworthiness of the borrower matters, and the quality of the instrument that's used is also an important consideration. So I'm going to focus on three areas that are of particular concern to me, and I'm going to start with the type of debt that is most relevant for Canada, household debt. Now, the bank has been clear that high household debt, which is currently at around 178% of disposable income, is our #1 domestic financial vulnerability. Low borrowing costs obviously contributed, but at the same time, other factors like housing supply constraints in some major areas like the GVA, strong interest among offshore investors contributed to higher house prices and also bigger mortgages. People in Vancouver can really relate to that. Now, Canada doesn't have the same issues around the quality of debt that the US had before the crisis, but it's still a worry because debt can put people in a pretty tough spot if interest rates change in a way they didn't expect or their income falls short of their expectations. Now, of course, we take this into account when we set monetary policy. Now, Canada is not alone in this. When you look around the world, you see countries like Sweden and Australia, for instance, who are facing similar household vulnerabilities. Let me turn to public sector debt. There are good reasons for governments to finance some spending through debt. However, debt can create vulnerabilities if it's not sustainable, or if it prevents fiscal policy from being in a position to respond to unexpected needs. And we saw this in the euro area during the financial crisis. There was limited fiscal space in some countries, and that meant that monetary policy had to bear the burden of reviving the economy. Sustained progress has been made there in some of the countries that faced a debt crisis about 8 years ago, but public debt in these same countries remains a concern. And this is partly because membership in the euro area prevents economic adjustment that goes through exchange rate movements. And there's no system of fiscal transfers to help smooth the country-specific needs. And so what this means is that the euro area countries that have weak fundamentals, not all of them do, but some of them do, are more prone to distress. Now, the United States and Japan, you might ask, well, they make up the largest share of public debt in advanced economies, but their debt poses less of a worry, and that's a relative statement. U.S. debt instruments are used as reserve assets because of their high credit quality and because the U.S. government bond market is the world's deepest and the most liquid. It's no wonder that U.S. government debt has benefited from strong global demand, particularly from China. Now, for Japan, most of the public debt is held domestically, which mitigates the risk. And my third concern is about corporate leverage. A growth in corporate debt, again, it can be a good thing, especially when companies are borrowing to invest in new capacity. But it has exploded over the past decade and has some risky qualities. In China alone, we just take China alone, non-financial corporate debt totals about 21 trillion US dollars, and that's about 1.5 times China's GDP and much higher than levels in most economies. It was fueled in part by very rapid growth in domestic non-bank financial institutions. That's our new way in the Financial Stability Board of saying shadow banking. Well, there aren't as many safeguards in this sector, the shadow banking sector, as there are in the traditional banking sector. So all that debt poses a financial stability risk for China. And what does that mean for Canada? Why should we care about that? Well, the risk could flow to Canada through lower demand for our exports and prices for our commodities. And of course, turbulence in financial markets. Now, non-financial corporate debt in other emerging markets amounts to about $10 trillion, and around 1/3 of this is denominated in US dollars. So it's foreign currency debt. Now, foreign currency debt can be an issue if it exposes firms to exchange rate risk that's not properly hedged. Now, we saw in the past, during the Asian crisis in the 1990s, how sovereign debt that was denominated in foreign currency led to instability that exchange rate devaluations only exacerbated. Well, I think in the same way, high levels of foreign currency corporate debt could limit the scope for exchange rate movements to play their normal stabilizing role. Now, non-financial corporate debt is also a concern for some advanced economies. If we just think about the United States and the euro area, the quality of corporate debt has deteriorated. We've seen a substantial growth in the BBB and lower rated bonds and a rapid increase in what we're calling leveraged loans. A bit of the shades of the beginning of the century. Now, non-bank financial institutions have played the biggest role in the buildup of all this corporate debt since the crisis. Why is that? Well, part of it is because global banking and global bank lending dropped off sharply as banks were repairing their balance sheets and also working to comply with stricter regulatory requirements. Now, the gap has been more than filled by a large increase in bond financing, and the investment fund industry has quite naturally capitalized on opportunities that are created by the retreat in bank lending. Now, the growth of these funds means that portfolio flows into equity and into debt are now the dominant source of capital flows worldwide. There are two reasons for this. The first is that the low interest rate environment in advanced economies has spurred investors to seek higher returns abroad. The second is the rising prominence of products such as exchange-traded funds, ETFs, that has made it easier for a broader range of investors to gain exposure to emerging market economies or to high-yield bonds. Now, the expansion of these products is a natural result of capital markets just picking up the slack after bank lending fell off. This is Ottawa's last blast of winter in my throat. And these products can offer investors greater diversity of risk. So they're not all bad. In fact, they could be completing markets in a good way. Now, what concerns me, though, is we don't know how these funds are going to react if a shock hits, and how the associated portfolio flows are going to evolve. We've seen more uncertainty in markets in recent months, but we haven't seen a really broad and sustained increase in risk aversion. We haven't seen that. But if fund managers were to suddenly shift their asset allocations, and the moves could spark a sharp reversal in portfolio debt flows, and the business models of investment funds could further amplify the resulting stresses. And we've seen that before in the past as well. Just think about the liquidity of ETF shares. It's widely thought of being higher than of the underlying assets. In a stress situation, herd behavior among ETF investors could amplify changes in the asset prices and lead to a bit of contagion more widespread. Now, all of this is pretty sobering. It really is. But we need to remind ourselves what is in place that will help keep us on track. And there are some things. First, the global financial system is more resilient than it was 10 years ago. Under Basel III reforms, institutions that are active globally, including institutions in Canada, Canadian banks, are better capitalized. And we shouldn't underestimate the importance of this. We really shouldn't. These banks are holding $2 trillion more capital than they were at the beginning of 2011, when the reforms were all being phased in. They're also holding more liquid assets and running their business with less leverage. Now, it's critical to be prepared for rainy days. And in fact, in December, Canada's Office of the Superintendent for Financial Institutions, which is sometimes fondly called OSFI, increased the capital buffer requirement for Canadian banks by 25 basis points to 1.75% of total risk-weighted assets. The stress tests of Canadian banks are a really useful way of assessing how much pressure could be placed on their capital in very tough but plausible situations. Last autumn, the Bank of Canada published a scenario by staff that involved falling house prices at the national level. And what they found is that our banks could handle such a shock. We're going to show more of this kind of work in the next financial system review that is coming out in May. OSFI's mortgage underwriting guidelines are also adding to resilience. And here I'm talking about the famous B20 stress test. They have improved the quality of new lending. We've seen that in the numbers, and they've done this by limiting the number of new mortgage holders that are highly indebted. Along with higher interest rates, the new guidelines have also limited the growth in credit. And as a result, we're finally seeing the ratio of household debt to income stabilize. Well, the second development that will help keep us on track is the fact that China is working to deleverage. And this is critical for an economy and for the world that they do that deleveraging. China is taking meaningful action, including more stringent regulation and supervision of the financial sector. This strategy, you can see it in the numbers, has helped to slow credit growth. It's also shrinking parts of the non-bank financial sector. Well, this is a good thing because the sector is less capitalized, less liquid, and more opaque than traditional banks. And while all of this is contributing to slower growth in China, it is contributing to slower growth in China, it's the right path to more sustainable growth in the future. Now, unfortunately, the trade conflict is making what is already a delicate balancing act for the Chinese authorities even tougher. Finally, economic growth will make public debt more sustainable if we play our cards right. Our research has shown that the rising costs of public debt are low when a country's economic growth rate is higher than the inflation-adjusted interest rate on its public debt. It's just simple arithmetic. In this situation, the growth will keep debt as a percent of GDP on a stable or declining path, even if the country is running a limited budget deficit. Now, if new borrowing follows what you can call the golden rule of fiscal policy, borrowing, that's just borrowing to make investments that support stronger long-term growth, like infrastructure, then there's even more scope for debt to grow and still remain sustainable. According to Bank of Canada estimates, many countries could grow over the medium term at a rate that exceeds the interest rate on their debt. Now, should countries stay on this growth path and governments limit new borrowing, current public debt loads could be more sustainable. Now, it's important to remember, just excuse me one more second, that a stable debt to GDP ratio doesn't guarantee sustainability. It helps to have a steady debt to GDP ratio, but it's no guarantee. What you need as well is a credible macroeconomic framework. That's critical to maintaining faith in a government's creditworthiness. It's also critical to achieving growth and to avoiding instability. Now, sound monetary policies and fiscal policies are at the core of this. That includes maintaining or building some fiscal space for when it's needed. Now, this was the case in Canada when fiscal stimulus was used to respond to the global financial crisis and to the oil price shock a couple of years ago. This helped central banks achieve their inflation objectives. And our inflation objectives is our part in supporting strong and sustainable growth. We also saw the importance of sound policy frameworks late last year. Some of you may remember there was a bout of outflows of capital from some emerging market economies. And investors clearly differentiated between countries that had sound frameworks and those that didn't. And this limited the spillovers. So we're in a better place than you might glean from the news. But that doesn't mean that there's nothing left to do. There certainly is. High leverage will always be an important vulnerability because of its hooks into the rest of the global financial system. We need to better understand these linkages to determine if additional safeguards are needed. And the best way to do this, at least I think one of the best ways to do this, is just to keep running stress tests on different aspects of the financial system. The auto industry has tested airbags for cars for a long time for how they perform in different types of collisions. A crash test for banks has only become standard practice relatively recently. More needs to be done to extend this type of analysis to new players in the system, and there are a lot of new players, like asset managers and other non-bank financial institutions that have become more prominent. Now, it's quite challenging to do this because their activity often crosses borders, and the ecosystem that needs to be modeled is very complex. Now, the Bank of Canada and the Financial Stability Board are both looking at how to model these interlinkages. I find these kinds of work on stress testing the system particularly worthwhile because it helps identify where safeguards should be maintained and where they should be strengthened. Now, regulators around the world also need to continue to make good use of macroprudential policies like the B20 policy that I talked about earlier to address localized vulnerabilities as they emerge. Even if these types of policies slow economic growth in the short term, they help to avoid more painful adjustments in the long run. And this is important for both advanced economies and for emerging market economies. Individuals play a role as well. You do. As I said earlier, high leverage can leave any of us in a vulnerable financial position. And I'm hoping that prospective homeowners and other borrowers are going to do their own stress test so that they can feel more confidence that the debt that they do take on will be sustainable over time. Now, before I conclude, let me take a minute to say what we should absolutely not do. Have a trade war. Advocates of protectionist measures say that imposing barriers like tariffs on countries that have trade surpluses will help reduce disparities in international trade. It will lead to more domestic production and more jobs. This logic may be very seductive, but it's misguided. In a trade war, no one wins and everyone loses. Tariffs lower GDP for everyone because they harm investment and they harm productivity. That's why it would be good for everyone if the United States and China resolved their dispute. An end to US tariffs on steel and aluminum would also be a welcome relief for many businesses and workers in Canada and other affected countries. And of course, the Canada-United States-Mexico agreement still needs to be ratified. Even with these steps, very positive, Getting over the general malaise about trade policies is going to require a credible plan to modernize the World Trade Organization's trade rules, including the rules for intellectual properties and its dispute settlement mechanism. This would pave the way for higher global growth and a more sustainable debt burden. So let me conclude. As I said at the beginning, global growth is now more than 3 times global GDP. Now, that's a headwind to growth, and it makes us vulnerable to another period of financial instability. The good news for Canadian businesses and households is that the financial system, globally and here at home, is safer than it was a decade ago thanks to much stronger safeguards. Aujourd'hui, la dette mondiale est plus de 3 fois le PIB nominal mondial. Et c'est un vent contraire qui souffle sur la croissance. Et ça nous rend vulnérables à une nouvelle période d'instabilité financière. La bonne nouvelle pour les entreprises et les ménages canadiens est que le système financier est plus sûr qu'il y a 10 ans. C'est grâce à des mesures de protection beaucoup plus solides. As we look ahead, the global expansion is expected to continue, even though it has slowed in recent quarters. For Canada, the economy is likely to be weaker in the first half of this year than we thought back in January, but we still expect GDP growth to pick up later in the year. That said, more needs to be done to further reduce the downside risks to the global economy. A long-lasting resolution to the current trade war is at the top of my list because the conflict is threatening growth around the world right now. Credible fiscal and monetary policies, nimble financial system safeguards are all at the core of limiting vulnerabilities and promoting longer-term resilience for all countries. What's at stake is the future prosperity of many people at a time when stability is sorely needed. Thank you.
I don't know if you need to take a minute for. You're less hoarse than Theresa May, I think. So as we said at the beginning, there's lots of time for questions and answers here, and so we have a couple of people with mics, Christine, Rashad. So start sort of formulating your questions and putting your hands up. Before we give you a chance, though, I'm going to use my privilege as moderator to ask you a question. And I mean, you sure live in interesting times. That was one of my takeaways from that. But as you went through the risks, and then you kind of talked a little bit about the safeguards, and I kind of felt like the risks were bigger than the safeguards. And so bringing it to Canada, thinking about, you talked a fair bit about the banking system, better capitalized and so on. But when we talked about China, we talked more about the shadow banking system and those kind of perimeter issues of, yes, you can regulate the banking system, but what about the things that are outside the banking system? And I just wonder if you could talk a little bit more about in Canada, whether those sort of non-bank financial institutions are within some regulatory umbrella and whether or not there's exposures here in Canada as well as overseas on there.
Sure. That's a great question because the size relative to the banking system of the non-bank financial institutions in Canada is not the same as it is in some other countries, although it's there. And I think the first point I'd like to make is the non-bank financial institutions aren't such a bad thing. That's why we wanted to drop the shadow. I use it because everybody sounds shadowy. and so we wanted to drop that. But then when you say non-bank financial institutions, people think, what are you talking about? Well, we're talking about repo markets. We're talking about asset managers and some other institutions that provide a good service to the economy because they help find right investments. They help to find financing, short-term and long-term. And they provide services that banks just don't provide. The issue comes up when either financial engineering or the activities get ahead of themselves in a way that sometimes can happen, even if there's regulation, but is more likely to happen if there isn't. And so we keep an eye on that. You know, some of the changes that have been made to address that for all countries has been looking at some markets like derivatives markets, looking at certain funds to making sure that they have liquidity requirements for the right gating that takes care of people deciding they wanted to take funds out and there was no money there to do it. So there's a number of areas. Mutual funds is another area that has been you know, heavily looked at. For China, the perimeter issues are less of an issue to the extent that they have more control over their entire economy. And so when they want to make changes, they can do it. I think for them, the challenge has been trying to do it in a way that keeps growth on a solid track, because it needs to slow down, that's for sure. They can't fuel that credit-induced growth for long. But at the same time, they can achieve growth of 6%. That's what we think their potential growth is, and work to deliver at the same time. As I said, it's just a bit of a balancing act. So I wouldn't want to leave the impression that I think the shadow banking is something you want to stamp out. It's just something that you want to put guardrails around to make sure it's doing the job it's supposed to do. You know, the one thing, though, that makes it more difficult for those of us who are looking at vulnerabilities in the financial system and seeing, okay, how can we protect ourselves about them is, you know, we've seen banking crises before. We know how it plays through the system, and we have data and we can model it. When there are new players, or these players are operating in different markets in different ways and at a different size, we can only do scenario analysis that's approximative. And so there's always the concern that you could be surprised.
Yeah, thank you. Is there a question right at the back there? Yes, please.
Thank you, Ms. Wilkins. You'd mentioned contagion, and as it relates to ETFs, in the event if there's a major fund flow out of an ETF. Can you describe how big this risk is, whether or not you think that investors realize this risk, and what policies the bank might have to address this?
So I think it's really difficult to say how big the risk actually is. I mean, you can just look at their sheer size of the market and go, wow, that's big. And but it's often not about how big a market is, it's who it's connected to. So whether it's ETFs or it's CLOs, you know, you really need to see what the connections are. And I think not all ETFs are the same. I kind of use that as a simplifying thing. They're structured in very different ways. And so risk can happen when the institution that's required to provide the liquidity has requirements that they can't meet, or that means that they have to stop providing other services to other market players they normally would, like making markets in corporate bond market, the cash market for corporate bonds. It could also happen when investors are relying on being able to get their funds and they find that they've been gated for a couple of days or a week or whatever. What the regulators around the world have tended to do is not overreact, but look at reasonable scenarios and say, okay, well, let's just see what kind of liquidity requirements we should have, or liquidity that you already have placed, or other mechanisms that mean that you won't be caught short. And so that's what's been done. But I think, again, I'll go back to when you've never seen it, you don't really know how it could play out. So for Canada, the types of ETFs that may be the more problematic ones, it's not a very big market.
Thank you. Other questions?
Thank you very much. My question would pertain for, even though Canada's banking system has policies and regulations that would better prepare us in case of a financial downturn, how could Canadians, even Canadians prepare themselves, especially if we're looking to expand overseas or even domestically?
It's always a tricky thing to give general advice to individuals because really it depends on their individual situation. Maybe I can just say that I touched on it a bit when I was talking about the stress test. That is, for those who are not familiar with it, it just basically says, you know, when you qualify for a mortgage, you need to be able to handle, given your income, a rise in interest rates or higher interest rates of, say, 200 basis points. And that just means that if rates go up, that you'll be prepared, you won't have to tighten your belt too much to be able to handle it. And that's something that the Office of the Superintendent decided to impose to kind of help banks and help financial institutions and their customers kind of do what you might think people who are managing their own budgets as individuals might also want to do, right? You think, is this financial decision going to take the test of time? And so, for individuals, that kind of practice seems to be one that is pretty wise. For businesses, it's a very interesting environment, and I think that's one thing that has surprised not individual businesses, but when you look at the economy as a whole, and especially for Canada, how hard it is to take business decisions in terms of investment in an environment where there's so much uncertainty. And I talked about the uncertainty coming from the trade situation, whether it's Canada-US, whether it's China-US, you just don't know what the regulatory environment's going to be. And when you're investing in something for the next 10, 15 years, you might either hold off or you might decide to do that in the US. And so we're seeing that a lot for Canada, but we're seeing that around the world. And I guess it's not advice, but it was my hope that that uncertainty will be resolved over time. That's finite.
And that there's not new uncertainties kind of piling on. Other question there at the back.
I'm appreciating hearing your thoughts. What I wanted to ask is, given the dominance of the U.S. financial system, what are your thoughts, like your personal sort of opinion, on the potential rollback of Dodd-Frank regulation and the leverage within their system?
Those are two, you're talking about the combination of those two things. Well, we all worked, some of us at the bank worked pretty hard on the financial regulation at the international level, and some of it was compatible with what was already in Dodd-Frank. Some of it wasn't. I think any government has a right to do whatever they want with legislation, so I'm not going to comment on specific things. I do know that when we did our regulation for Basel, and I was co-leading the working group on liquidity that did the LCR and the NSFR, which are very popular. People love them. You know, those are new regulations that make banks have the right amount of liquidity to serve the needs that they have and keep them from running out of money even though they're solvent. It just sounds like a really good idea. But when you write things down for global financial institutions and you implement them locally, sometimes you learn that you didn't get it exactly right. We have to be humble when we're making new regulations. And so part of the relook at Dodd-Frank, without getting into specifics, could be quite naturally that. I think where anybody needs to be concerned is where instead of fixing a problem, it's being loosened in such a way that financial institutions or others are not properly reducing the probability of taking on too much risk, or are not prepared when that risk goes, or if that risk goes pear-shaped. Those are the kinds of things that you want to argue against if you can.
That's a technical term, right? Pear-shaped risks.
It's very visual.
Yes, question in the front there.
Hello? Hi. I think two of the key risks that you discussed were trade tensions and geopolitical risks such as Brexit. And at least my belief is that those risks are somewhat driven by a perceived inequality. And I was curious as to the work and risk management that the Bank of Canada does with respect to the distribution of capital and problems that may or may not arise from that.
Sure. Well, the first part of your question is what's kind of led to the movement where people who once thought and argued that globalization was a great thing and would create wealth and prosperity, not only for advanced economies, but for emerging markets as well. And you look at the data, and there are distributional implications that have come out in advanced economies that may be related to trade, but also to technological change that came with it. But it's lifted millions, billions of people out of poverty. So you think, well, why would people turn their backs against that? And it may very well be, there's all kinds of theories, but part of it may be the widening of the distribution of income, the poor feeling poor and the rich, some very few getting richer. That may be part of it, and a failure where everybody believed that trade is gonna help everyone. And so that may be part of it. The thing about monetary policy, when you think about it, is it can't affect or target particular distributions of income. You have to think of what can monetary policy achieve? Well, it can achieve changes in the prices, and that's it, okay? So that's kind of the long-run neutrality of money. And so, but at the same time, some of the actions that we take, the framework that we pursue, targeting 2%, has implications for the distribution of income. And so what we do and what we intend to do in the renewal of the inflation target regime, which comes up every 5 years, next one's 2021, one of the criteria that we're going to look at when we are looking at, say, a 2% inflation target or a dual mandate or nominal GDP targeting, whatever we decide to look at, one of the criteria, not the only one, will be, well, what are the implications of pursuing a different framework for the distribution of income? Other than that, we do not have any role in distributive policies like tax policy, but when we do advise the government in areas like macroprudential policies, changes to the underwriting rules for mortgages, we try as best we can to understand how it affects different people in different regions and different income levels differently, so that the policymakers who are taking that in the decision have that information and they can take it into account the way they see fit as elected officials.
Another question in the front here.
Thank you. Today's speech is one of the few speeches you make every year. So what's your expected reaction from the market tomorrow after today's speech? Is it like a relief or like possibly like an amplifier to the investor risk? Because today there are many portfolio managers sitting here.
I think today's speech was more about where I see an underlying vulnerability to the financial system, and then of course to growth that's about tail risk, and not about where I think the mode of the distribution is. They're going to take, I'm sure they're going to understand that and react the way they want to. It's interesting though, it allows you to, we always think that when a central banker speaks that there's some point of trying to get across that will affect markets. And this wasn't the case today. The point that I wanted to get across is we can worry about growth and we can worry about some of the regulatory changes and the things that are happening out there. But I wanted to explain to people that sort of an underlying structural vulnerability that is independent right now of the trade conflict or is independent of many of the other things that are going on is going to be a headwind for growth, even if those situations are resolved. Now, resolving those situations is actually very helpful because it allows the expansion to continue at a stronger pace than it would have otherwise. But we can't forget that those vulnerabilities are there and they need to be dealt with.
Okay, there was another question, I think, at the back there with the microphone. Yeah, sorry, there you are. Oh, it is on?
You talked about this significant amount of leverage that's in the system, particularly within Canada, which makes economies more interest rate sensitive.
Yes.
How do you incorporate that into your forecast for a neutral rate? And should the neutral rate of interest be lower given the fact that economies are more interest rate sensitive, regardless of sort of productivity and
we discussed that. That's a great question. If you've been bugging our room, because I have to say that's a really good question. There's a couple of ways to look at that, but if you focus on kind of the medium-term notion of a neutral rate of interest, which is what we do, so that's our 2.5% to 3.5%, which we'll be updating in the April monetary policy report. That notion is for a small open economy. Can use different models, largely determined by global savings and global investment, as well as savings and investment in Canada. But the global forces are pretty strong. Now, if you think about, well, what does that mean that indebtedness has nothing to do with the neutral rate? I don't think that's true either. The way, and maybe every deputy governor or the governor may explain this in a different way or think about it in a different way, but the way I see it is that you need to take into account that the changes in interest rates that you make, in this instance, the ones we've been making have been moving up, are going to have a stronger effect than they had in the past because people are so indebted. And that means that getting back to neutral would be something that would take longer. Now, some people, the thing that gets confusing is some people talk about a short-term neutral rate, which is just kind of where the appropriate place for monetary policy is. It takes that into account. But for us to do this, to understand how does indebtedness affect the transmission mechanism and how do we measure that instead of just waving our hands and saying, well, it's more sensitive, we've altered our model in a way that takes into account explicitly borrowers in the economy and can sort of measure how interest rates are going to affect them and their credit limits that they might have. That's the simplest way to explain it. There are other things that we do. That's just a model. We do checks with microdata, which we have, which has all the households anonymized. We can look at their financial situations and kind of see, okay, if they took a mortgage out in 2014, what does that mean for their mortgage rate? We survey people and we watch the data closely.
There's lots more questions that could be asked, and there's going to be time in the reception afterwards for you to ask, but I'm only going to take one more question from the audience there in the middle.
Hello. I'm curious as to how the bank looks at the evolving fintech landscape in Canada and how consumers interact with things like subprime credit products through the fintech avenue, and how does the bank see the regulatory environment changing over time to address that industry?
Well, fintech covers a very large span of activity, and what we've done at the Bank of Canada is spend a lot of time trying to understand it in the first instance. And to do that, you have to do it at the global level, because if you look just at Canada, the activity in fintech is pretty small. So peer-to-peer lending or crowdfunding or all these kind of platforms, not a big source of funding in Canada. Even ICOs are not particularly a strong source of financing at this point. But globally, there's a really good litmus test. China is an excellent place to kind of figure out where things might go. And so that's one of the work that I did with the Financial Stability Board when we were looking at were there financial stability implications of various types of fintech, and we concluded, and I would still conclude that not yet, not now, for sure, but there were certainly regulatory issues that merited a lot of attention right away, and they started with consumer protection and market integrity type measures, anti-money laundering, counter-terrorist financing, because these, whether it's the activity between the people or the portal through which it was going through, in fact, there's no visibility. There's pseudo-anonymity. Some of them, there's even more anonymity than pseudo. It was an opportunity for activity that wouldn't build trust in the financial system. And so that's kind of the place to start. Another place to go for crypto assets, if we just carve out that part of fintech, is being very clear about what kind of objects we're talking about. If you're gonna apply a regulation, you need to define what it is. Is it a payment system? Is it a security? Is it a utility? And once you define that object, you can create the regulation. And so that's where authorities, including the Bank of Canada, are working on right now. You know that the securities regulators have already got some regulation around the world for crypto assets that are defined as securities. So I think it's a really exciting space. I just said a lot about the risks, but at the same time, it's an opportunity to create efficiencies, cut out the middleman in many areas, including payments, increase financial inclusion, especially for countries that are not as developed in their financial systems as we are. And so for me, the regulation isn't about curtailing it. It's about preserving the good stuff so it doesn't get tarnished by some of the activity. And we've got a rather famous exchange that went down. And does anybody here have their money locked up and trying to look for the key? So
it is an exciting space. I want to thank you, Carolyn, for your insight across all of these different areas. But I especially want to thank you for putting a human face on an institution that for many people in this room is far away, it's in Ottawa, it's just a building or possibly a banknote. And you've made the questions that they're addressing and how we think about them so much more human. So thank you so much for that. Please join me in thanking Carolyn.